The IMF talking about gold's role as money and not a barbarous relic, and its role as an international reserve currency, whether it be a vehicle or part of an international reserve system. You got the head of the IMF coming out 2 weeks ago and saying that CBDCs need to be backed by something in order to give them stability. You have all of the European central banks repatriating their gold from the New York Fed and the Bank of England. You have central banks buying more gold over the last 18 months than at any time in history, the biggest first quarter ever on record by the central banks. My feeling is that the only way that this really truly works is by pegging it to gold. But
it is a breaking news. The EU has recently made an announcement proposing the introduction of a central bank digital currency, CBDC. We welcome you to our channel, where Andy Schectman, a prominent figure in the financial services industry with over 25 years of experience, will provide valuable insights. Andy Schectman, the owner of Miles Franklin Limited, has a deep understanding of the current trends in the industry. Schectman finds the concept of CBDCs intriguing, particularly when it comes to trust. He recognizes the concerns about diminishing trust and considers it a relevant and captivating topic. Later in the program, Schectman will discuss this further on this video. In addition to his expertise in precious metals and bullion, Schectman has extensive knowledge of Swiss franc investments and alternative investments. He has previously appeared on our channel Metal Crisis Unfolded before. Today, we have a multitude of topics to delve into, including the outlook for the next 6 months. Our discussion will cover bullion price developments, supply chain issues, and premiums, as well as other relevant aspects. Stay tuned to hear Schectman's valuable insights as he shares his thoughts on these topics.
The issue here, at least in terms of North America, is this continued fight between inflation and interest rates. And yes, they've raised rates very fast, about 10 straight rate increases to get to where we are at roughly 5%. But yet we're still below the levels of inflation. We haven't done anything to really tackle inflation. They talk about this 2% inflation target. We're a good ways away from that inflation target. So the question becomes, where does the policy go? Does it go the way that it's always gone, where politicians choose inflation over austerity, over the tough decisions, or do they really raise rates high enough to start to really put tremendous strain, much more than we've already seen, not just on the banks, which I think are really in big trouble as this happens, but also on the businesses, the corporations who are having a hard time maintaining status quo, hard time in gaining access to capital at a reasonable rate. And I think we're going to see, as we get closer to the 24 election, at least here again in North America, an environment where rising rates can really, really damage the ecosystem. And what makes things worse is that the regional banks, which have seen massive outflows, which have really, I think, not gotten anywhere near out of the woods. In fact, there's in the neighborhood of $100 billion in this emergency lending program that the Fed set up to backstop these fragile banks. So we're nowhere near the end of it, but these banks hold 70% of all the small business loans. They hold approximately 70% of all of the commercial leases and loans on the commercial real estate. And all of these things being tied together in terms of accessing capital, whether it be refinancing leases or loans on property, or whether it be access to capital for businesses that are struggling in this environment, which the inverted yield curve tells us with a great level of predictability that we are going to see some sort of a recession on the horizon. Some people will go as far as to say a depression. Any way you look at it, to me, it feels as though we are in the eye of the hurricane, where we got bruised and battered on the front end of the storm with the banking failures and all of the fallout that ensued after that. But now it's as if everyone is looking to greener pastures. They're looking to an environment where maybe equities are on a bull run again. We're looking to an environment of a soft landing. And I would like to believe that be true, but unfortunately I don't. I think the trailing edge of the storm is coming. And this is a moment where I think it would be a very big mistake to believe that we have crossed that line and are looking to growth and prosperity again in the future. Quite frankly, I think we're nowhere near that, and have a lot more to get through before we see that type of environment again. Gold would languish a little bit, but it's important to understand there is a term in economics called Gibson's paradox, which speaks to the inverse relationship between the price of gold and real interest rates. Now, even though you got interest rates on the 10-year treasury barely at 4% right now, but the federal funds rate at, I don't know, 5 or whatnot, you have inflation much higher than that. We are below the level of inflation. And if you're buying a 10-year treasury, in fact, I'm going to cheat right now, and I'm just, while we're talking, 10-year treasury yield is currently
3.72.
3.7, right. So you've got 3.7 on a 10-year treasury yield, yet your inflation by the lying CPI standards is basically double that. And if you take a look at what John Williams of Shadow Stats would tell you, using just the metrics the way they used to be calculated before they changed the metrics to meet their inflationary agenda, we would be almost 3 times higher than that in terms of inflation versus yield. So when you talk about real return, your negative real return right now is at least 3% compounding if you believe their numbers, and potentially as much as 7, 8, 9% compounding. And so gold should really do well in this environment, in a real negative yielding return environment. Look, the bottom line is that gold has been suppressed for so long by the West in an effort to support the bond market, in an effort to support this illusion of a strong dollar. And at the same time that we are seeing the dollar or the price of gold get hammered, let's talk about something real quick in terms of what we've seen with deliveries off of COMEX. The biggest money in the world, the most sophisticated money in the world, has been draining COMEX and draining the London Metals Exchange to a level that we've never seen before. Massive deliveries coming off of the exchange month over month over month. 4, 5, 6 months ago, there was a report that came out of the IMF that said gold, an international reserve currency, a barbarous relic no more, ? The IMF talking about gold's role as money and not a barbarous relic, and its role as an international reserve currency, whether it be a vehicle or part of an international reserve system. You got the head of the IMF coming out 2 weeks ago and saying that CBDCs need to be backed by something in order to give them stability. You have all of the European central banks repatriating their gold from the New York Fed and the Bank of England. You have central banks buying more gold over the last 18 months than at any time in history, the biggest first quarter ever on record by the central banks. My feeling is that the only way that this really truly works is by pegging it to gold. But why now? I'll tell you why. Jim Rickards just came out, and I've been saying this for 3 years. In every interview I've done for 3 years, I've been screaming the BRICS going to issue gold-backed currency. What did James Rickards just say? August 22nd, the South African meeting, he believes they will issue or introduce their new commodity-backed currency. Now, they told us it will be backed by a basket of commodities, gold included. Jim Rickards thinks that becomes too convoluted, that it will most likely just be gold. What did the IMF just say? Gold's not a barbarous relic no more, ? What did the head of the IMF just say? CBDCs need to be backed by something. I was asked this question in Vancouver by Michelle McCory from Kitco. What do you think could derail or challenge the BRICS in issuing this currency? And by the way, the BRICS and the Belt Road Initiative and the Shanghai Cooperation Organization and the New Development Bank, well, by the way, OPEC is, Saudi Arabia is involved in every one of those institutions, every one of them. All the OPEC countries are on the Belt Road. This is a trend where the dollar's hegemony is being called into question. And I think if I'm OPEC, if I'm Saudi Arabia, would I rather sell my oil to a country that has chosen inflation over austerity, that is inflating away their currency, that is going green, that is not supporting the combustion engine fossil fuel agenda. In fact, is pushing back against it and moving away from it, and is openly antagonizing Saudi Arabia in that respect. Do you think they want to sell us their oil, or would they rather join up with an amounts to 90% of human population that is going to issue a commodity or gold-backed currency, and you know, they're all using oil. So all of these things are spinning very, very quickly. But my real feeling is that the reason you're hearing about all of this stuff right now is that there is a very strong and somewhat substantiated rumor that they're going to issue a commodity-backed currency to challenge the Western hegemony as soon as August 22nd. So